The stock market just dropped 20%. So naturally, everyone's asking the same panic question. Do you buy now or do you wait for the bottom? Spoiler alert, nobody rings a bell at the bottom, and yet somehow we all convince ourselves we'll hear it. Here's what's actually happening when markets fall. This hard, this fast. It's rarely just one thing. It's a cocktail of rising interest rates, tightening liquidity, shifting investor sentiment, and sometimes just plain old fear feeding on itself. Think of it like a crowded theater where someone yells, "Fire rational or not." People run, and the exit gets ugly fast. We were just celebrating all-time highs. Financial media was printing champagne emojis, and retail investors were treating brokerage apps like slot machines. And then, almost overnight, the mood collapsed like a souffle. Someone slammed a door on. The headlines that once screamed "bull run forever" got quietly deleted, replaced by somber recession warnings and expert pivot videos that aged about as well as a milk carton left in July. The psychological damage of watching your portfolio bleed is genuinely underestimated. Studies show that the pain of losing $1 feels roughly twice as powerful as the pleasure of gaining $1, which means bear markets don't just hurt your account, they rewire your decision making. And yet, legends like Warren Buffett have built entire fortunes on a simple premise. Be greedy when others are fearful, which sounds easy until you're the one watching red candles at 2 a.m. History, though, is remarkably consistent. Every single bear market in American history has eventually been followed by a bull market. Every single one, without exception. Whether it was the crash of 1929, the dot-com bust of 2000, or the pandemic freefall of 2020. The catch is that eventually is doing a lot of heavy lifting in that sentence. Because eventually can mean 18 months, or it can mean a decade, and your mortgage doesn't care about your time horizon. Markets move in cycles the way seasons do, painful, predictable in pattern, yet somehow always surprising in timing. And the communities of long-term investors who've lived through multiple cycles will tell you that the scariest moments almost always turn out to be the best entry points in hindsight. Almost always, and that word almost is where fortunes and therapists both earn their fees. Let's kill one misconception right now. Waiting for the bottom is not a strategy, it's a fantasy. Because by the time the data confirms the bottom and the market has already bounced 15 or 20%, and you've missed the recovery's most explosive days. The investors who sat in cash waiting for certainty in 2020 watched the S&P 500 rip 40% higher before they felt safe enough to buy safety is expensive. The practical lesson history keeps handing us over and over like a patient but slightly annoyed professor is that dollar cost averaging, buying consistent, fixed amounts at regular intervals regardless of price, removes the impossible burden of timing and replaces it with discipline. You don't need to be right about the bottom, you just need to keep showing up with a plan. Bear markets are also where you audit yourself, because owning stocks when they're up is easy, but owning them when they're down 30% reveals whether your risk tolerance was real or just something you said confidently during a bull market. Size your positions so that even a further decline doesn't force you to sell. The investor who survives is often not the most brilliant one, but the most solvent one. The process always beats the prediction. Your entry price matters less than your exit discipline, your position size, and your ability to not panic sell into the exact moment of maximum fear. Markets are designed, almost cruelly, to shake out the impatient right before rewarding the patient. Bear markets are not the enemy of the investor. They are the mechanism through which wealth transfers from the emotional to the disciplined, from the reactive to the strategic, from those chasing certainty to those comfortable with probability. The market doesn't owe you a comfortable entry point. It owes you nothing, which is oddly liberating once you accept it. Here's the philosophical truth that ties it all together. You will never feel ready to buy during a bear market, and that discomfort is precisely the price of admission for the returns that follow. Discipline, consistent sizing, and a process you trust matter infinitely more than perfectly timing any single trade. Whether the market drops another 10% from here or rockets back tomorrow, your preparation, your plan, your position sizes, your emergency fund, your timeline is what determines your outcome, not the market's mood. You can be comfortable with either scenario when you've built a rational strategy instead of an emotional one. If you're thinking about putting money to work in assets beyond just stocks, whether it's real estate, renovation projects, or anything that needs financing, we can help you get started in real estate investing, home contracting work, and finding lenders. So check out our links in the description below.